Hello, everybody, and welcome to this week's Middle Class Investor. This is Seth Martin, your host. It's Saturday, about almost 12:30, and you can see here we had a pretty big down week in the S&P 500 and in all the major indices, actually, not just the S&P 500. And from open to close, this is probably the most significant week we had since, at least in the last 52 weeks, the last year or so, since this week right here. In fact, this past week, from open to close, the range was, I don't think it was 130, and maybe the open and close range on this one was like 120. So pretty significant selling. Certainly cause for concern in the market. Of course, we've been expressing concern here for a while, but a lot of this was so a lot of times when the market starts to sell off, people start looking for causes. Okay, and of course there's quite a bit of turmoil going on in the Chinese market. If you've gone online and watched YouTube videos of these empty Chinese cities and stuff, you just know that the government's intervention over there into their economy has been significant. And in the way they have intervened is in credit expansion. And if you study credit expansions and now, when I'm talking about credit expansion, I'm talking about artificial credit expansion due to central bank policy and things like that. Once you start one of these credit expansions, they always end up in a bust. I mean, there is no correction. There's no soft landing. And so you've got that going on over in China. It actually started last year with their market sell-off, and you're getting the next leg down. Now, why is it happening almost 8 months later? Well, it's because this particular degree of trend is very, very, very larger. The best way to describe it is the next closest degree of trend bear market that we experienced, that's like the one we're in or about to begin, is probably 1974. So, but this one's larger. I've talked about this before, about the market being a fractal. So the 1974 bear market that ended in the 74 is a smaller fractal than the one we have now. So the one we have got going on now, or the one we're starting, is of the next degree larger. So it's like the next outer ring, or if you're looking at concentric circles, and that's what makes these moves big, and they're going to get much bigger. So that's one of the main reasons I wanted to start this YouTube channel, is to try to keep people out of the market, when this is going on, because there is no way to diversify yourself out of the type of selling that's in store for us. It's caused by a general deflation and lack of availability of credit, and then that's caused by just the sheer amount of debt there is worldwide. So now this week we had some specific causes, okay, and so on any day you can have news that can cause fluctuations in the market. But the larger trend, whatever the trend is not governed by daily news. It's governed by large macroeconomic conditions that are set in motion by either groups of people, or governments or whatever. So anyway, so this week in China, their government intervention continues. I mean, they tried to set some circuit breakers on their markets, and on 2 different occasions this week, the market was shut down. One when they had a 5% circuit breaker, and then the second day, I think it was on Thursday, their Thursday, or our Wednesday night, they set a 7% circuit breaker, which was tripped, and that market session was only 29 minutes long. So anyway, the government over there has done all kinds of crazy things. They think they can control the markets, and of course they can't, and they're going to learn the hard way that they can't, but it's not going to keep them from trying. They've already threatened to throw people in jail that were short selling the market. They've done all kinds of things that are just, crazy, basically, in non-free markets. So I would expect that to continue, especially as the selling becomes more intensive and more people are losing money and their businesses and things of that nature. Until maybe this week, I've been talking about the market bouncing and making a new high up into this resistance area. And I suppose that's still possible. There's still a probability of that, because there's always a probability. The market, you can never say 100% of the market is doing this or it's doing that. You have to think in terms of probability. And even though I don't know the actual probability number, I'd say the probability of making a new high from here is pretty low. Now, we do have a gap here. There's a gap right here between here and here, and at some point that gap is likely to be filled. So that's another reason why I think there's still a decent probability of the market making a new high, but it's going to have to get busy here pretty quick, because and what I'm seeing here is you potentially have a kind of a triangle forming, like so. I guess it'd have to be like that. And so the way the triangle works is you have this run up, and you have a pullback, which is your first move of the triangle, and then there would be your second move of the triangle. Let's say we're in the third move of the triangle right now. Let me redraw that because it didn't draw very well. And so what we would expect is there's so A, B, C, D. You have a move like this, and then a move like this, and then a move to newer highs. So we should see fairly early next week, if this triangle is going to be the pattern, then we should see something happening pretty early next week. In fact, what we should see is something like an inside day or an inside week. So for those of you that are bulls, ideally what you want to see is something like this, next week. And then the following week, you want to see, something like this. Okay? And that tells us that probably going to go up here to this trend line and then turn down and then eventually break out of this triangle to new highs. Now, I don't think it's going to go much higher. I mean, you might just make a marginally higher high. So right maybe at the early edge of this blue box here, maybe closer to the middle, so 2175. But we're not going to have, a substantial move out of this triangle, I don't think. So let's talk about the bearish scenario. The bearish scenario is I don't know, it's equally probable. I mean, you don't have this kind of selling activity and not have, potential for bearishness. On a short-term basis, there's really no support here until you get down into this area where we have this blue box. So but that's not uncommon with triangles. If you do have a triangle forming, they seemingly turn where there's no support and change directions. The reality, though, is if it is a triangle, and we don't know if it is or not, but if it is, then the support is a diagonal support that connects these previous lows with this low. And if that doesn't work out, then we're probably coming down to this 1850, 1840 area before we get kind of a bounce. Now, even then, I'm going to show you something else. Even then, the bounce could be very short-lived if this is bearish. So, you might come down here, hit this area, retest the underside of this line, and then really sell off from there. That's a potential, and I'm going to show you why that's a potential. But I need to go out to like let me change this to a monthly and see if that does it. So some of you might have heard of something called a head and shoulders pattern. And we call these things, we give these things names because, I zoomed in too much. You have to give, you don't have to give them some name, but we give them names just to help us, identify with them a little bit. But the reality is a head and shoulders pattern is just an area where particular price action has developed a pattern that generally, and you could have an inverse head and shoulders pattern, which would be bullish, or just a regular head and shoulders pattern, which is bearish. Now here would be the left shoulder, here would be the right shoulder, and then the head, and then here would be the left shoulder. And this is a particularly bearish looking pattern. It's very large. Again, it's kind of like the ending diagonal that I was talking about a while back. Sometimes when these patterns are large, they turn out not to be patterns, but it's potentially there, so I wanted to mention it. The way you measure these head and shoulders patterns, you go to the top of the head here, down to the neckline here. This is called the neckline, this line that I have drawn here. And then you duplicate that to the downside, which is about right there. And what is right there? I don't even know what right there is, but because if I take this off, then my lines go away. But it looks like maybe down into this 1500 area would be the head and shoulders pattern. So just be aware of that. But if it does break this neckline, it's likely to find support here, retest the neckline, and then sell off into the 1500 area. So anyway, if depending on which scenario happens, we potentially have some losses coming our way, and or we've got some potential gains from here. This is why, though, a while back, and I don't remember what week we were talking about this, but it was in here when we were getting all this congestion. It was having such a hard time getting up into this resistance area, and I said, 2125 is a pretty good. It's a pretty good gain. The market's really struggling. It's not likely that a bear market would continue from here. We were talking about, just taking some money off the table, maybe even just going to the sidelines at that point. And in retrospect, that probably would have been a pretty good idea. You would have missed a lot of this turmoil that happened in August. And then, this new turmoil that's starting to happen now in China and the Asian markets. So, I don't know, it's just something to think about. It's hard to do because we get greedy. We say, well, maybe it could go a little higher. Well, again, what's the risk and what's the reward? The reward is maybe another %, maybe 2%. The risk in this case was 10%. So that doesn't make a lot of sense. And these are the ways you need to kind of think about. You don't need to. It's just one way to think about the market. When you're not living through this, you sleep a little bit better. there's just there's a level of comfort, a lack of weight on your shoulders when you kind of operate this way, as opposed to just diversify all your money and put it in everything. Okay, here's the VIX. You can see the VIX spiked up and is back above this green trend line that we had, which was kind of underneath these lows back here. And, the VIX is still in a range. I mean, still within this blue box. And maybe the range is even bigger. The VIX doesn't stay high for very long, usually, unless we have some prolonged selling and a lot of fear. So you might see the VIX go a little higher and then get back into this range. Let's look at 10-year Treasury. The 10-year Treasury is probably the most problematic for me based on what we've been talking about in this YouTube channel. And the reason is because it's just it hadn't made any lower lows yet, but it's just really kind of doesn't look like it's to me this looks more corrective still, which means it might need to make at least some lows back into this 1.9 area. Excuse me, I had to yawn. So I'm watching the 10-year Treasury close. The bottom line is, though, bonds in general, we really don't want to be in them in a credit deflation environment. These prices are only going to go lower, and yields are going to go higher. And right now, junk bonds hit a 9% yield, which is pretty high. I mean, I would say it's probably above normal. And so you might get a pullback, into about 6% yield, which means, bonds might bounce here up into this, junk bonds might bounce into this 36 area. But then just beware, because credit is going to start getting very, very tight over the next couple of years, and bonds are going to underperform in a huge way. Well, everything's going to underperform, but bonds are going to be particularly damaging because the forces there at work are just going to be very, very great. And you just probably don't want to be in the way of that. But I am seeing that the 10-year Treasury is not following the same as the junk bond yield. So it could be that the 10-year Treasury, and if the market sells off, money flows into treasuries and causes that market to causes those interest rates to fall a little bit based on the demand for those bonds. But again, that is going to be short-lived, and just be careful about that. All right, let's see here. Let's look at, I really don't want to look at Germany or anything. Let's look at the Wilshire, because the Wilshire is 5,000 stocks, and clearly it's looking much weaker. It's almost down here to these August lows, and probably will be next week. We could look at the Russell. The Russell 2000 is also, very weak looking. It's actually below. No, it's not. It's not below its October low yet, but it's well below its August low and its September low. So, it looks like the Russell and the NASDAQ 100, it looks like maybe small cap and tech are reversing pretty quickly here. NASDAQ Composite looks a little stronger because it's got some big names in it. But I think the 100 is a little weaker. We can look at the United Kingdom. I mean, it's broken its support area, so maybe it's time to define a new one. The next swing really is this one down here, and we're probably going to hit that in short order. So let me go ahead and draw a box off. I'm looking at this November 12th low. And I'm just going to draw a box right in here, just below that low. And I would look for the UK. We'll look at the FTSE here in just a few minutes, but we'll look for the UK to probably come down to that next level of support. Let's see what Germany looks like. Germany has not hit its support area yet, but its next area is probably down here below this low, this 2012 low. So we can go ahead and we'll draw a box there. Global markets are looking weak everywhere. The patterns are very, very large, and it's taking a very long time for this to play out. But when it starts really picking up steam, it's gonna be pretty damaging. And hope the people that have been watching The Middle Class Investor are either standing on the sidelines or they have some sort of strategy that's going to keep them out of this trouble. Let's go to my NinjaTrader platform and look at oil. This is a monthly. Well, first let's go back and look at oil on here. This is a very long-term chart. It's a weekly chart. You can see the 2009 low way back here. This was the 2008-2009 financial crisis, where oil just dropped like in 5 months. And then we had this move that just kind of lumbering move back up. And then the move down started back here on, what is this? September, let's call it August 26th of 2013. It's hard to believe oil technically has been going lower since then, but it has. And you can see here that off of the 2008 low, the 2008-2009 low, I've drawn this yellow box, and you can see we're very, very close to it. And I would just look for oil. There's a 1.618 extension here. I would just look for oil probably to head down to this just below $30, $29.95, $29.80, let's say, before it bounces. But when it does bounce, and we've talked about this, we're going to see a bounce up into this 65, 68 area. It's going to retest this group of pricing right here where I've got this yellow box. And so that's going to suck some more people in, and people are going to talk about, the sell-off in oil is over and all this other stuff. And then we're going to have another leg down that's going to take us pretty deep here, probably, I'm just guessing, probably below $15, $12, something like that. So just be careful. Don't rush into energy. It's okay to buy energy stocks and work for a bounce. I was noticing, I'm looking at them. I was noticing Apache looked pretty good. Not yet, but Apache maybe gets a little lower than I would look for Apache to make a move up into this area right here. So, let's say Apache pulls down to $30, $31, and you could buy Apache and trade it back up to about 60. It's a good trade. That's it's doubling your money. So nothing wrong with that. I would stay away from, companies like Chesapeake. Can't remember the symbol for Chesapeake. CHK maybe? Yeah, Chesapeake. I think Chesapeake has major problems. I would stay clear of that one. I would stay clear of Devon. What's Devon? DVN. I think they've got some additional. What I'm looking for are companies that don't really have. See, Devon, for example, has a bunch of oil sands assets. And the problem with these oil sands assets, to be profitable, oil needs to be like $70 a barrel. Well, so they have a bunch of money tied up in these assets that just aren't going to be making any money. So that's why I'm saying stay clear of Devon. The reason you want to stay clear of Chesapeake is just they have a lot of debt. They just have a ton of debt, and right now oil prices are not high enough to service that debt, and they're either going to be getting rid of those assets at fire sale prices, or they're going to be filing some sort of bankruptcy. They're going to be going into some sort of bankruptcy proceeding. So I would stay away from that. All right, now let's go to NinjaTrader. I've got the continuous contract up here, and so you can see, I've talked about Elliott wave before, but you can see here we've got a wave 1 down, we've got an ABC back up. This created a TS3, which is a wave 3 signal, which normally, you know, if you were trading oil, you would have traded right here to about $50. But of course, this wave 3 is a 1, 2, 3, 4, 5 in here. So 5 is almost complete. Probably got another, I don't know, $3 or $4, and then this is going to be complete. And we're going to see a pretty good bounce in oil. Like I said, back up to an area just above here. Let me go ahead and mark it. Spending a little bit more time today just because the markets are kind of crazy, and I'm sure, you know, if you're watching this, you probably got more questions. So I would look for oil to bounce. Once it stops making its lows, you could bottom fish around here around $30, $29, something like that. And then I would look for oil to make a pretty rapid move back up into this area. It's going to shake out a lot of shorts, and it's going to be a pretty violent move. So, I mean, it might go like this. It might. Let me zoom in. This happens a lot at the end of these wave 3s. You get a little blip like this, okay, that pulls back almost to where it started, and then this move is just violent, straight up like that. So keep an eye out for that. Maybe if you're looking to trade oil or buy some energy stocks, you might want to look at that. Let's see. I've got the DAX in here. I think I updated the contract. Yeah, I guess it's a March contract. So DAX doesn't look too bad. It's just still chopping around, but I'm sure it's going to get dragged in with all the rest of these things. And I thought I had, yeah, here's the FTSE. Again, it doesn't look too bad either, although this move down here was pretty significant in the spring and summer. I don't know. I think these markets, once they kind of work out their final gyrations, they're all going to start moving together. And that's why it's going to be very difficult to hide from the selling that we're going to be experiencing here soon. Let's just look at the ES here for a second. The problem with the ES, or not just the S&P 500 is the ES, by the way. The problem in trying to find an area where the selling might stop is there's just no support anywhere along here. So, it could be that the ES and the S&P is just going to go all the way down here to our support box around 1820. And if you look at this as just what it looks like to me is, it looks like kind of in the Elliott wave terms, it looks like a 1-2-1-2 potentially. Now, like I said, it could be a triangle, and we could be on our way back up. Assuming it's a 1-2-1-2. You've got a wave 3 here. Just in this wave 3, let me do it like this: down wave 3, 1, 2, 3. You're kind of at your target, but then you have this other 1-2 up here. So it could be that this is going to continue. We might get some bounces in here, but this is going to continue down until we hit this decision point support area down here. And but there's no way to know. I would say if you're short the market, and the way, and I haven't talked about that, but one of the ways you would do that is you would buy something like the SDS. I like the SDS because it's very liquid. I can show you. Let's see. Let me just show you real quick the SDS. There's other ETFs that you can buy, but you can look here. Well, this isn't live market, so this doesn't really reflect this. But these are a couple of pennies between the bid and the ask. And the volume is pretty high too. Like if you were to look at the volume of the SDS, let me turn that on real quick. Volume pane. So you can see here, let me put it on a daily so we can see what it trades on a daily basis. But on a daily basis, the average volume is down here around 20 million shares a day. And you can see here in the last couple of days, it traded more like 30 million shares a day. So this is a very liquid instrument, and you can buy this instead of trying to short the SPY. Which you could do. You can short the SPY if you're comfortable shorting. It trades even more. It's even more liquid. It trades 180 million shares a day. So whatever you buy, if you're gonna try to make some money on the downside of this market, and this goes for any time you're trying to buy or sell anything in the market, you just want to shoot for things that are liquid. So pull up something, look at average daily volume, and that'll give you some idea as to how liquid the instrument is. If you buy 1,000 shares of something and it only trades 10,000 shares a day, and one day you want to sell all 1,000 shares, you might not be able to, or you might not be able to sell at the price you want to sell at. So just stay with liquid instruments. Don't trade. Don't buy some exotic. I don't know. I was looking at Dust a while back. I think Dust still trades quite a bit, because it was following this pattern, so I was trading in and out of Dust. It seems like I thought it was less liquid than this, but it's not. Anything over 1 million shares a day is plenty liquid for most of us retail middle class investors. So just if you go and you search Google for short ETFs, or you want to go long gold. I mean, if you want to start looking at going long gold, you can buy the GLD. If you like silver, you can buy SLV. Just keep in mind that when you own these things, these aren't the actual. You don't own any claim to actual metal. You just have to be. This is not the same thing as buying silver coins or buying gold coins. So just be aware of that. I could pull up. Maybe I'll do it next time. I'll show you in an Elliott Wave forecast where they think we are in the price of gold. In case you're thinking about buying gold or silver, we're right smack in the middle of a pattern that is likely to take gold prices lower eventually. And I just thought I'd show you what that looks like, but I think I'm going to do it next time because I don't have the financial forecast up. But really long term, a really good price for gold is off of this little area right in here, which is, I'm just going to do like this. So you're talking about $600. So what does that mean? That means we're going to have some sort of run up here, probably into the 1500 area, and then a wave C that'll take us down into 600, and potentially maybe off of this low here, which is more like 450, 480, something like that. So anyway, before you say, oh, that can't happen, or you argue, I mean, just keep an open mind. That's all I would say about that. I mean, certainly if you have the money and you want to buy gold now, I think these are good prices to buy gold at. It's still readily available. It's possible that when we get down into this 600 or 500 area, there may not be any gold to buy. I mean, it just may not be produced, or it's so little of it's produced that the commissions, to buy it, right now maybe I don't even know what the commissions are per ounce. I know on silver it's about 80 cents per half ounce, so about $1.60 per ounce. For gold, the commissions are much more than that. But it could be, for example, on silver, instead of $1.60 per ounce, you you could end up paying, even though silver's cheaper, you might end up paying $8 per ounce in commissions. So that's how that works. I mean, there is no perfect place to buy any of this if you're going to buy physical metal, because you have to get it from somebody, and somebody's going to make a commission. And if it's not readily available, the commissions are likely to go up, or you just can't get it at all. So just keep that in mind when you're looking at things like precious metals. All right, everybody, that's it for the week. I think the last thing I'll say, just real quick here, is if on the S&P 500, let's just go back to that real quick. Let me get hide volume. Okay, hide volume. All right, if the S&P 500 takes out really either one of these lows, but certainly this August 24th low, the triangle is out. No triangle, okay? Just forget about the triangle if that happens. There will not be a higher high, most likely. So if we break this low right here, okay, no more higher highs for the time being. Now, that doesn't mean it doesn't necessarily mean you're going to want to sell right away. I mean, what you could do, once we break this lows, you could get a bounce, and so maybe you could sell back up in here. So, but I just want to dispel, any conversation you may be having in your own head regarding a higher high here if we take out this August 24th low. All right. Hope that does it for everybody. If you have any questions, just comment in the comments section. If you disagree with something I say so also in the comments section. I'll try to read them, and then if it's something I can bring some evidence to, I'll do that. That way, because I certainly am open to what you have to say and how you see the markets moving and things like that. I don't claim to be right about everything. It's just something I've been looking at for a long time and studying and trading, and I feel like I've got a pretty decent handle on them. But certainly there's people out there that know more than me and have more experience than me, and and if you're one of those, certainly comment and we can chat about it and bring it up here so that everybody else is exposed to your comments as well. Okay? Thanks a lot, everybody. We will see you next week, and Happy New Year. Happy 2016 to everybody. Bye-bye.